Hi, class. Let's start this chapter. We'll talk about the Canadian financial system. In this class, we will talk about the Canadian financial system, which has a little bit of differences between them and the US, Canada, US financial system. Also, we will see some difference than they're not exactly a European system, they're not Americans, they have their own system, but there is a huge similarities between them. In the Canadian financial system, what we want to learn is explain what money is and what makes it is useful. We like to list the three components of Canadian financial system and explain how it regulated, discuss the role of financial institutions that we have play in the providing services, and then describe the role of financial market, outline the role of clearing settlement system that's applicable in many of the world. So the first part that we want to talk about it is actually what money and what makes it useful. Money, anything that people generally accept as a payment for a good or service. So it doesn't have to have the same, any tools that people accept it as a payment for a good and service. And there is what you call a barter, which is a trading of good and service for another good and service, which is they done it in the old days directly. No particular, it is difficult to carry around, so you cannot carry a cow and get a two ships, for example. So that's the reason you do, there is a hard, this is not practical because it is difficult to carry around goods and services. Now, useful form of money, money has to be portable, as we said, so it's easy to carry around. Is divisible, that you can divide it into coins and bills, $100 and the $10, 10 pieces of dollars or $250. So coins and bills can represent different values. It has to be stable. Everyone agree on its value and durable. Coin can last indefinitely, and it's it has to be unique. It is hard to counterfeit or copy, otherwise everybody can copy it and the value of it goes down. There would be no value actually. What's in the Canadian financial system? What we have something called Bank of Canada. It's a central bank. And Bank of Canada provides liquidity to the system, to other banks. It's a bank for the banks. It gives policies, advice to the federal government, oversees a major clearing and settlement between banks, systems, and countries, and contribute to international discussion on the financial system issues. Now, in the Canadian financial system, there is what you call, we have a traditional banks, we have what you call a credit unions, we have the French version of the credit union cases popularities, and we have a trust companies. We also have non-banks like the pension and mutual funds that you get from insurance companies, commercial financial companies, consumer financial companies, and the brokers. These are non-bank, also provide a financial system. The regulating the financial system, although highly regulated, Canada is a highly regulated, there is no single body overseeing the financial industry in Canada. Responsibility is shared among different organizations at a different level of the government. You know, it's a federal, provincial, and the city government. Federally, Department of Finance, Office of Superintendent, Financial Institution, example, Canada Deposit Insurance Companies, and Financial Consumer Agency of Canada. This is on the federal level for regulating the financial system. You have makes profit by using customer deposit to invest into interest-bearing loan to the customers. So they do help you to recognize as one of the safest and the healthiest in the world, because you want to put your money in a very safe and healthy place. Canadian banks have branches also all over the world, so it's easy to really deal with other banks when it comes to money transactions. The banking industries, we have the leader is TD, which is Toronto Dominion, Royal Banks, comes the second recently, Bank of Nova Scotia, Montreal Bank, and CIBC. These are major banks in Canada. And then you have to look at the amount of the dollars in billions. So $1,279 billion TD has, and RBC has 1,200. Is it really? Another one. Some service provided by the bank. As you know, banks compete with the life insurance companies, compete with other financial companies. They also provide them. Other financial might compete with them, but a life insurance on a credit products that can give you brokerage services, financial counseling, telephone and internet payment option, different option, safe deposit boxes. These are extra services that you see from the bank, registered retirement account, traveler check if you need, demand deposit, time deposit, credit cards. They can give you a line of credit. They can give you loans, mortgage for your housings. They also can provide you with overdraft protection and ATMs. The Canadian financial market, what we have what you call a security dealers. We have IPO, or the initial public offering. We have what you call prospectus, and security commissions, and stock exchange. And the security dealers is a firm that trades security for its client, other form of money is a security bond for its client, and offer investment services. In the IPO, the first public offering of a corporation. So they provide stocks. You can buy shares and they call them stock. A condensed version of economic and financial information that the company must make available to investors. And before they purchase any securities, Security Commission is a government agency that administer the provincial security legislation. And then we have what you call the stock exchange, which is not as good as big as others, but it's significant, an organization whose members can buy and sell security or exchange them for companies and investors. Choosing the right investment strategies. There is 5 keys for criteria when you're selecting any investment option. First, you look at the investment risk and how much. Second is the yield, how much interest you're going to get. The duration, how long you have to keep your money there. Liquidity, how quick you can get your money back. and the tax consequences, that whether you're going to get some tax breaks for these activities. So in Canada, when you're investing in bank, stockholders are part of the owners of companies. So when you buy stocks or shares, you become an owner of that company partially, according to the amount of the stock. The share price usually fluctuate, depend on how well the company is doing. There is what you call from fluctuation where you can sell it if it goes high, and there is what you call a capital gain from it, which is a positive difference between the purchase price of the stock you did and when you sold the price. And then we have what you call stock indexes, which is measure the trends of different stocks exchange. When it goes high, shows you, and how it goes down. And usually people buying it on margin, which is about purchasing security, borrow some of this cost from the brokers, and there is a what you call a stock split, which is if you have 100,000 stocks and so you make it 200,000, which is an action by a company that gives shareholders 2 or more shares of a stock of each one they own, so they can, sell them or have more shares. The same prices, but they split them. These are understanding some stock quotation. No need for going on the details, but if you can, that would be wonderful to understand, to get involved in it. Now, there is what we have in Canada, something called investing in bond. There is what you call the government bond and the corporation bond. The government bond guarantee income, but with a very little risk in Canada. But the revenue, the rate is less than the corporate bond. And the reason is the corporate bond more risk than government bonds. The interest earned from bonds are taxable. So when you make money from bonds, it's taxable in the corporate ones. If a bond are sold before the maturity date, some interest will be lost there. There is, I've taken I'm certified in the bond and insurance. So I do, there is lots of information, but just stay with this, that should be enough. Generally, if the interest rate goes up, bond price goes down, because what do? You want to put it in a bank and have the interest rates journey. There's what you call a mutual fund. So a group of people put money together and start investing. This is a simple explanation for a mutual fund. Mutual fund is a fund that buys stocks and bonds and sell shares to those security to the public. Mutual funds are managed by usually professional managers. So everyone puts the money, they have $2-3 million, professional managers, and they manage these funds. And then you have the diversification, which is you might buy several different investments. So if somebody goes down, you still have other things that goes out. In the money exchange, they call the basket of money. In the stocks, they call them the diversification. So the purchases of a mutual fund may or may not be charged fees or commissions most of the time. Here's a comparing investment. As we said, you can have bonds, you can have preferred stocks, you can have common stock, you can have a mutual fund, and you have the ETF. And look at them, try to understand how they are working. There is another one that is being taken off. Banks are doing called TSFE, which is you can invest in it and buy shares within, whether in different stocks has a tax shelter. There's some rules involved in it. Now, clearing and settlement system, the financial market infrastructure, or FMI, is a system that facilitates the clearing, settling, or recording of payments. So when you're buying, there is a settle of payments. Some money goes from your account to their account. Or recording of payment, securities, if there is a derivative, or other financial transaction among the participant entities. Also, it's called a clearing or a clearinghouse and settlement system. And oversight of FMI or financial market infrastructure that could pose systematic risk or payment system. So risk is the responsibility of Bank of Canada. It helps to mitigate the risk when trading is happening. So in this chapter, we try to make it very brief because it's almost last week. Money is anything that people accept or as a payment for goods and service. The 5 standards are portability, divisibilities, stabilities, durabilities, and the uniqueness of the money. The 3 components of Canadian financial systems are financial institutions, the financial market, and the clearing and settlement system. The Minister of Finance is responsible for the financial system, that which is we said, this part of it. Financial institution, it can be banks, credit union, insurance companies, trusts, or any other financial firms. Financial market consists of market for money, bonds, equity, derivative, or foreign exchange. So you can keep US dollars also. A clearing or settlement system in every country, such things available, also called financial market infrastructure or FMI, plays an important role in enhancing stabilities. Thank you.